Welcome back to the program, everyone. Thank you so much for joining. Thank you for being here. If you're new, please make sure that you are subscribed to World Affairs in Context on Substack or Patreon for more and exclusive content. Just follow the links in the video description below to get connected. I would absolutely love to see you there. So I have big news for you today. China just ordered its banks to limit their exposure to US government bonds, to US Treasuries. So let's talk about what just happened with China, US Treasuries, and why this story matters a lot more than the headlines may suggest. Chinese regulators told banks to limit their exposure to US government bonds. No formal announcement, there hasn't been a press conference to my knowledge, just verbal guidance that was passed along to some of the country's biggest banks. Remember, in my recent interview with Larry McDonald, we discussed global investors reducing exposure to dollar-denominated assets. Larry, who is a financial expert, explained why this is happening in great detail, and if you haven't watched that interview just yet, please check it out next. It's rather short, but I believe that you will learn a lot from it. I will link it in the description below for those who are interested. So China's move to limit exposure to US Treasuries taps straight into a much bigger global conversation about risk and whether US debt is still the unquestioned safe haven that it's been for decades. Now, the global shift away from the dollar is out in the open right now. It's no longer a conspiracy theory. Chinese financial regulators have advised banks to slow down or curb their purchases of US Treasuries. And if a bank already has a large position, they're being encouraged to gradually reduce it. China says, don't hold it, go ahead and reduce your positions. The official reason given is concentration risk and market volatility. And in plain English, it means too much exposure to one asset, especially one that's been swinging around a lot lately. And regulators were very careful to frame this as risk management, not geopolitics. So they explicitly said that this is not about a loss of faith, a loss of confidence in U.S. creditworthiness. They try to be very diplomatic, as you can see. And it also does not apply to China's official state holdings of treasuries. So those will remain untouched for now. And that distinction actually matters because China as a state and Chinese banks are not the same thing, as you know very well, but some people may not be aware and may confuse the two. The central bank needs liquid dollar assets for things like currency intervention and financial stability. But on the other hand, commercial banks have balance sheets that can get hurt if bond prices swing sharply. So they are effectively hedging. And so now the guidance itself was delivered verbally over recent weeks. And based on what we know, there were no targets, no deadlines, and no hard numbers, just sort of a nudge in the direction of diversification. But guess what? Global financial markets did notice this. As the news broke, treasuries slipped somewhat and yields edged higher and the dollar weakened. Yes, it weakened more. And this is enough to show that investors are sensitive to any signal that involves a foreign demand for US debt, especially when it comes from China. Let's talk about numbers, because this is where things often get misinterpreted or misunderstood. Chinese banks held about $298 billion in dollar-denominated bonds as of September of last year. That's the most recent information we have available, that we have access to in any case. It's not even clear how much of that is treasuries. Meanwhile, China's total treasury holdings, state and private combined, were about $683 billion in November of 2025. That is the lowest level since 2008 and nearly half of what China held at its peak back in 2013. So it has been gradually reducing its holdings of US debt. It used to be number one holder, well, not anymore. And it's definitely sticking to its policy of reducing its reliance on US dollar denominated dollar-denominated assets. China used to be the largest foreign creditor to the United States, and that ended years ago. So Japan passed China back in 2019, and the UK overtook China last year. So when people hear China cutting treasuries, it sounds very dramatic, naturally, but the reality is China has been slowly reducing exposure for over a decade already. And here's where the context actually becomes very, very important. Global investors are already questioning Washington's fiscal discipline, and they have been for several years now. US deficits are massive, truly massive. Debt issuance is out of control, and on top of that, there are growing doubts about long-term dollar policy. President Trump has openly said that he's comfortable with a weaker dollar, and he's made threats about tariffs, floated wild geopolitical ideas like Greenland, and he repeatedly pressured the Federal Reserve in the past. So all of that feeds into global uncertainty. Trump might be comfortable with a weaker dollar to boost US exports, among many other things, but that is a very questionable path to pursue if that's what he's after. Last month, a Deutsche Bank analyst even warned that European money managers could start trimming US assets in response to political risk. Remember, several weeks ago, I uploaded a video on European pension plans actually reducing their US Treasuries holdings as well. We're not talking about China or other foreign states. We're talking about European pension plans that are very, very conservative, saying we need to exit US debt because we can't trust US foreign policy, we can't trust US fiscal discipline anymore, and we're going to take our money elsewhere. And that's precisely what they're doing right now. And not because the United States is about to default, but because the direction of policy feels less predictable. And that is the key theme here, predictability. China's regulators are looking at a world where bond markets are moving violently. Volatility is out of control. Gold just surged and then suffered its biggest drop in 4 decades. Several days ago, by the way, I uploaded an entire video with the details of why gold crashed, why silver crashed, and what to expect from gold in the future. I sort of discussed that very briefly in the video. And on top of that, Japan's government bond market saw a $41 billion meltdown as well in recent weeks. So volatility is literally everywhere. In that environment, holding too much long-duration US debt becomes too risky, especially for banks that need stable balance sheets. China's move to reduce holdings of US debt reinforces a broader global trend. For example, India and Brazil have already been reducing exposure. Investors are hunting for alternatives. Gold keeps coming up, and so do other currencies and assets, to be honest with you. And so if China were to aggressively dump treasuries, yields would spike, markets would seize up, and the global financial system would feel it immediately. Everyone knows that, including China. And that is why, in my opinion, no one expects a fire sale. This is not going to be a fire sale. This is going to continue being a very slow and gradual reduction. But that path is very, very symbolic. What we're seeing instead is something arguably more important than a fire sale. This looks more like a gradual erosion of the unquestioned status of US assets. So keep an eye on this, because this is very important, and not because China is about to crash the treasuries market, but because this is another small signal in a growing pattern. The world is still buying US debt, the dollar is still dominant, but the margin for error is shrinking, and the list of people asking very, very uncomfortable questions is definitely getting longer. Thank you very much for watching. Thanks so much for being here. Please support my work. I appreciate every single one of you who has become a paid subscriber on YouTube, Substack, or Patreon. Thank you so much for your support, and I look forward to seeing you here tomorrow. Take care.